Hello and welcome to today's Premium Account Market Update for December 2014. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presented today myself, Leon Hein, Managing Director of Investor Signals. I have over 17 years of experience in the financial services industry as a licensed securities advisor. The topics for today's presentation, we look at a quick summary of the macro update driving global equity markets. We roll through the ASX Top 50 with a particular focus on the FY 2015 earnings forecast, dividend yields, and how that fits in with our overall portfolio strategy and asset allocation, and conclude with a short-term Australian market outlook. Investor Signals service is a premium account broking service based on a model portfolio of ASX Top 50 stocks. We focus on using call options to enhance portfolio returns, which is around the effective ownership of owning the stocks around ex-dividend dates and complementing those returns with a covered call income to generate above average cash flow. Still seeking to deliver some moderate capital growth. The portfolio is managed under a strict investment mandate suitable for self-managed super funds, and the assets all remain in your name. If you'd like to know more about the Investor Signals service, please contact me, Leon, at investorsignals.com. Moving straight into a graph of the US market being the Dow Jones. Now, on a forward, so the September quarter earnings in the US essentially met market expectations. We've seen a 10% sell-off throughout that September period. The market's now well and truly re-established new highs. On a forward forecast over the next 12 months, the market's looking for somewhere around $125 to $130 of earnings on an annualized basis out of the S&P 500. I think what that means is the Dow has a fair value of about 16,500 points if we applied a 16 times multiple. The fact that the US market could easily trade up to 18, 19 times forward earnings without it being too overstretched from a valuation means that the Dow could trade up into sort of 18,500 points should the earnings continue to track in a relatively strong and measured way that meets market expectations. There's some cynicism there around global growth with the slowdown in China, Europe, and Japan. However, the stimulus measures coming through from the ECB and the BOJ, I think, probably has equity market participants looking sort of 12 months down the track and thinking that probably the Federal Reserve rate increases are unlikely to be a dampener on economic growth, and the continued sort of flow or flood of cheap capital out of the Eurozone and out of Japan is probably likely to continue to underpin equity markets. So our base case is that equities continue to grind higher. The domestic market, it's really a case of, well, where does value still exist? And look, at a macro level, I suppose just running through, we've seen disappointing manufacturing data from, China, Europe. We saw China sort of reasonably underwhelming manufacturing PMI data yesterday. We know the European manufacturing data has generally been poor. We saw Germany's PMI data come in below expectation, and that was essentially the lowest reading for 17 months. But some of these things, I think, are in the rear vision mirror for equity analysts, and I think, again, they start looking forward 6-12 months. Do these stimulus measures start to deliver growth? Does lower oil prices assist consumer confidence, consumer spending? Does the housing recovery continue? Those type of things is where I see equity analysts focusing their attention, and I think in most cases those things are still reasonably positive for equity markets. The Australian market trading at around 15 times forward earnings, looking for around about somewhere between 6 to 8% earnings growth, and I think there's a real disparity there as to what sector of the market that growth comes from, and as I roll through the top 50 stocks we'll start to focus on that. But you can see the graph on screen. The Australian equity market essentially moved sideways now for over 12 months, and that was really our base case. So this shading here on screen was something that we put in place, or I put in place going back in October, November last year. So we've essentially seen the market spend the last 12 months tracking pretty close, probably 80% of it or 90% of its trading range has been within that shaded area, and I don't think that changes too much, albeit that I think the market probably starts to get a little bit of support down here at around 5,200, 5,300 again, and I'd expect us to sort of possibly trade back up to the top end of that range. Okay, moving on to the first of the graph. What used to be AGK now has sensibly been changed to AGL to match the name of the company, so the ASX code is no longer AGK, it's AGL. When we look at this from a valuation perspective, the company should deliver, I think, maybe up to 5% earnings growth. There could be a little more upside there through the Macquarie Generation acquisition that I've been chatting about. But I think at these levels, it puts a stock on almost a 5% dividend yield and about 14 times earnings. I think the stock can trade back up towards this sort of $14 range, and I think that's the time to sell the covered calls. So a combination of the dividend yield out of AGK and that call option, we're driving about 10% cash flow, and we have a target there back at around that 14.50 as a range. Asiano, so this is one I've chatted a fair bit about. We're seeing the market look for around 10% earnings growth, and that's predominantly coming through cost cutting. So for that reason, remain a little bit cautious on Asiano. The stock trades about 14 times earnings on a 3.25% dividend yield. So you can see here on screen I've marked where I think we're probably happy to start running the numbers again on Asiano back here at around 550. So not doing think they're short term on Asiano. Amcor, I've always maintained this is an asset that we want to try to keep exposure to. We've cycled through this name a number of times, and with the benefit of hindsight, you could argue that you're better off just owning the stock and not selling the covered calls. But as you see sort of through this period here, essentially from November last year through till September, the stock largely moved sideways. I think we're probably getting reasonably close to where we see another period of that. And to put into context what's happening here in Amcor, the company's delivering about 8 to 10% underlying earnings growth, predominantly US dollars, so when converted back to Aussie dollars, it helps with the dividend capacity of the company. But the stock's probably due for slight earnings upgrades, but even working on the current numbers, the stock's trading on about a 3.5% dividend yield and trading about 19, 20 times earnings. So it's expensive, but I think the downside risks to it are pretty limited, and there's still prospect of further earnings upgrades over the next 6 months or so. So it's a name we want to keep exposure to the extent that we own it at lower levels, and we're going to be forced to deliver the stock. We're ready to buy back into it again and sell covered calls maybe up at around that $13, $13.25 level, and try to keep exposure to the ongoing uptrend there in Amcor. AMP not doing here at the moment. Just to give you some numbers on this, the stock trades about 15 times earnings on a 5% dividend yield. The market's looking for about 10 to 12% earnings growth into F year 15. The banks have all been under pressure a little, and we've seen this before. After their ex-dividend period, they underperform, and then coming back into the next round of dividends, which won't be until May, we'll probably start to see a slight pickup in some of these names. CBA's first in line out of the big four to pay its dividend, which will be roughly around February. Look, my thinking here on the banks is probably underlying growth's only around 3%. They've probably hit the top of their cycle as far as adding back into earnings the reprovisioning of bad loans. So I think sort of the higher dividend payout ratio, the add back from provision loans, is probably behind them. Therefore, the underlying growth, 3 to 5% on a yield basis, the stock's still attractive. Most of the banks yielding around 5.5%. So I think there's space in the portfolio to remain exposed to the banks. Our preference still remains probably Westpac and CBA as our preferred exposure. APA here trades on about a 4.5% dividend yield and delivering maybe somewhere around 5 to 8% earnings growth. ASX, we've been moving back into ASX and accumulating the stock again on this recent pullback, and just on a relative basis to other areas of the market. If you think about ASX in the context of it having about 5% underlying earnings growth, it'll pay out about $1.85 in dividends over the next 12 months, puts a stock on over a 5% dividend yield and trades about 17 times earnings. I think that the profit and revenue lines of the business are reasonably defensive. There's still prospect of corporate action, so it's one of those stocks that I think it makes sense to hold it in the portfolio, sell at the money covered calls or reasonably tight covered calls, turn the 5% dividend yield into around 10% yield. So our strategy is we've been buying it on pullbacks and trying to sell the covered calls up at around this $38 level. Again, sort of on an annualized basis, that's sort of bringing in around about $3.50 to $4 of income as a combination of the dividend and the call income there. AZJ, so interesting this one. The company delivered about 13% earnings growth in FY14. In FY15, we should see that grow by roughly another 10 to maybe 15%. I'm probably sitting at the lower end of that range, about 10% earnings growth. They'll pay out about 20 cents in dividends, puts a stock about 15 times earnings on a 4.5% dividend yield. The interesting thing here is the company's going to buy back 5% of its shares, or roughly 100 million shares. Now that'll be earnings accretive, obviously, and it'll underpin the share price. So I think whilst the technical structure here looks a little bit bearish with a negative, or a lower low and a lower high in the distribution indicator coming up there, I'm inclined to think that the stock probably finds support here, maybe rallies back up to this 470 level, and then we look to sell the covered calls up at around 480, 490 to drive that extra income and complement the dividend yield there. BHP, iron ore still remaining on its lows of around $70 US a ton. What was the strength for BHP being its energy portfolio, its oil and gas, has now somewhat acted as a deterrent against the comparison of, say, Rio. So where once, going back 3 to 6 months ago, the market viewed BHP more favourably than Rio because of its energy exposure. Right at the moment, that's been brought into question. So that leads us to the big correction in equity markets over the past 2 or 3 weeks has been the shift in oil prices from 90 or 100 US dollars a barrel down to $70 a barrel. We saw large overnight moves last week in oil, where on Friday gapped down about 10%. That would be consistent with large money managers around the world having extremely long portfolio exposure to oil and gas on the troubles that were occurring in the Middle East and with Russia. It was considered a one-way trade, so there was a lot of money. And so where I'm heading with this is the question needs to be asked: what's happened to oil? Is Saudi Arabia intentionally keeping prices low? In which case that strategy requires a 2 to 3 year time horizon for it really to start to impact the funding of the shale projects in the US and other smaller low-cost production around the world. If that's the case, we're in for obviously 2 to 3 years of lower oil prices. If, on the other hand, it's a short-term phenomenon and it's designed as effectively a raid on stop losses or weak hands within the energy market, we could see a much sharper pullback in energy prices. And I probably sit in that camp that I think you'll probably see oil trade back up 10 to 15% above where it is at the moment, and then resettle and trade sideways at or near those levels. If we do get a pickup in global GDP into the middle of next year off the back of the stimulus measures that are coming through from Europe and Japan, then it would be hard to see oil remaining at lower levels. So to some extent, I think BHP really does start to represent some pretty compelling value, especially coming into next year's split of its effective unwanted resource assets from its main 4 pillar assets. So to put some numbers on BHP, the stock trades, and we assume that what we're seeing in these resource names is obviously a big pickup in production levels, especially in iron ore. We're seeing a reduction in capital expenditure. So the net effect of lower prices in the market with those two positives is that we're probably not going to see a huge downgrade to earnings. I think the brackets may be somewhere up to maybe 10% maximum on the downside. So even allowing for that, we'd expect BHP to be delivering about $1.30 of dividends, trading on about a 4.5% dividend yield and about 11 times earnings. So the stock's still reasonable value, as I've been alluding to there, as it trades down at these levels. Now, Brambles, on the other hand, the market's looking for around 10% earnings growth. That's been reaffirmed by the company, around 27 cents of dividends in 2015. The stock now trades on a 2.5% dividend yield, trading about 24 times earnings. So it's very expensive. A lot of money's pouring into these US dollar names at the moment. Again, like Amcor, it's expensive, but the probability of them having slight earnings upgrades, currency tailwinds that support earnings, I think make these names defensive. When you look at Brambles across, say, the last 9 months, it's largely traded sideways. Back in March this year, it was trading close to $10. I think it's at the top end of this trading range now. Probably trades between $9.50 to $10. But I think if you go out into the middle half of next year, I'd expect to see Brambles finding support at $10 and probably trading up towards $11 as a new range. So we want to keep exposure to these names to the extent that we own it at lower levels and we'll deliver it under a call option. We're getting the benefit of the call option, the dividend, some capital gain, and we just look for that next period where the stock consolidates and moves sideways, where we can grind out sort of 2 or 3 extra rounds of income from the call options, while still giving us the opportunity to capture capital growth along the way there. So Brambles is a name that we continue to like in portfolios. CBA, again, around 3 to 5% underlying earnings growth, trading about 14 times earnings, 5 and a bit % dividend. When you look at the context that back in May the stock was trading around $79, here we are 6 months or more later and the stock's still essentially the same price. I think we get this period of consolidation, may run another 2 or 3 months, but eventually I think CBA starts to edge higher again into the early part of the new year. Coca-Cola, so we've seen the parent company come in and inject capital through a 30% stake in the Indonesian bottling business. Hopefully what we're looking at here is the worst is behind us for Coca-Cola. The company's guided towards flat earnings growth across the next 6 months, maybe returning to 5 to 10% earnings growth after that. So we've taken the opportunity to sell the covered calls, bring in some extra income from the call premium and the upcoming February dividend. We're bringing in around 50 cents of income over the next 6 months, and that gives us upside in the stock up to around $10. In order for the stock to be trading above $10, it'd have to be compressing down to the low end of a 4% dividend yield, and I think it starts to run into resistance there. But gradually over the next 2 to 3 years, hopefully we're looking at a recovery underway there in Coca-Cola. Computershare disappointed the market a little bit with their forward guidance. After delivering 10% earnings growth, they've guided towards maybe 5% earnings growth at best. It is a beneficiary of a lower Aussie dollar or strengthening US dollar. The stock trades at about 2.5% dividend yield, about 17 times earnings. We do have a negative structure here where we got the lower high, and the pressure is to the downside, but certainly somewhere around this sort of $10.50 to $11, I think the stock starts to look interesting again. It's certainly on our radar as an area where we'd like to redeploy capital into Computershare. CSL, interesting numbers here. So the company's buying back a further $900 million worth of shares, so you've got added additional demand in the market there, but the stock's currently trading 27 times next year's earnings, or FY15 earnings. Stock trades on a 1.5% dividend yield, so expensive by any measure. But again, this is the thirst for where capital's running into these US dollar earners. CSL's somewhat unique that it has a very low dividend yield but a very high underlying EPS growth, and again put that in context, around 12 to 13% underlying earnings growth. But one would have to think that it's going to run in a resistance within $1 or $2 from where it is at the moment. It'll be subject to some profit taking just off the back of that valuation concern. Crown Casino back at fair value here, 16 times earnings and roughly a 3% dividend yield. So we're interested in this. I think it consolidates and moves sideways. Dexus Group not doing anything there. Fortescue not really doing anything too much here. The stock's probably down a fair value. If you consider that their all-in cost has probably come back a little bit to around $60 a tonne. They're making a very small margin at or near these levels. If they can continue to increase production and we see iron ore trade back up to maybe 80, 85 a tonne, you're probably looking at the lows here for Fortescue around $2.50, I think. Goodman Group within the property space, I've spoken about this name. It's one of the strongest performers, delivering about 8% underlying earnings growth. Continues to be a buy on the dip story, but it is expensive. Now trading on a 4% dividend yield at about 14.5, 15 times earnings. But any consolidation and probably a opportunity to continue to have exposure to the long side there on Goodman Group. Our preference, though, has been GPT. We've been buyers of this again. We own it off lower levels here. It pays a dividend at the end of December, roughly around the 23rd of December, of 10 to 11 cents. The stock's growing earnings around 3 to 5% on around 15 times earnings. So owning it here and selling the covered call, collecting the dividend, driving about 10% cash flow out of GPT. IAG we like, so we've seen them integrate the acquisition of the Wesfarmers insurance business. The stock trades on around 10 times earnings and a 5.5% dividend yield, so relative to other areas of the market starting to present reasonable value, and we think a forward earnings growth of 5 to 8% is pretty achievable there. Iluka not doing there at present. IPL, one of our preferred assets again at the moment. IPL delivered a great result for FY 14, slightly exceeded market expectation, about 15% underlying earnings growth. The company's forecast to ongoing strengthening dividend payout, which is tracking at around 11 cents at present on an annualized basis, puts the stock on a yield of about 4.5%. I think we can see it trade up to $3, $3.10, but through the added production that's coming through from the Maramba plant and the Louisiana plant that's scheduled to be completed in the next 12 months, I think IPL can gradually grind higher and maybe up towards the 320 level, but we own it at lower levels. We've sold the 320 call into December, so again the income from the call option and the dividend driving about 10% cash flow and keeping some exposure to capital growth there as IPL trades higher. James Hardie, the recovery in the US housing market probably hasn't been quite as strong as some were looking for there with James Hardie. When you look at the numbers on the business, it trades at about 5% dividend yield. I think somewhere around this $11 level, the stock looks fair value. I'll just flag again that from a technical perspective, we've got this lower high structure in place, which would normally suggest that there's downward pressure on the price. So we're not allocating capital to James Hardie yet, but it's an interesting one for us to continue to revisit in the future recordings. Lendlease, high valuation, 15 times earnings on a 3.5% dividend yield. This company should pay out about 52 cents of dividends in FY 15. We saw FY 14 that was complemented through the sale of the Bluewater project there in the UK. The underlying growth of Lendlease is probably somewhere nearing on around 10%, so it is a little bit above average from an earnings growth perspective relative to the other areas of the market, but it is expensive on a 3.5% dividend yield and 15 times earnings. So, we're attracted to this name, but ideally being able to pick it up at lower price levels. MGR, interesting, it's on the radar, but our preference is probably still given is Stocklands and GPT, predominantly within the property space. But to put some numbers here on Mirvac, 15 times earnings and a little bit over 5% dividend yield, the company will probably only deliver around 3 to 5% earnings growth. So we'll continue to watch the earnings trends there in Mirvac. Macquarie Group highlighted that they're likely to slightly exceed last year's earnings forecast. So we're looking for the stock trading around a 5% dividend yield. Structurally, we've got good higher high pattern in place here. So the concern there here with Macquarie is just its leverage to the overall market. So if there is a market correction of any type, obviously Macquarie tends to be leveraged to that move to the downside. So to the extent that we consider Macquarie, it really requires some type of stop loss strategy in place in portfolios. NAB within the overall banking space. So if we look at NAB across the last, say, 12 to 18 months, again, it's largely moved sideways, trading around this $32 range on support, resistance up around 36 to 37. It's back at the lower end of this range at the moment. I think it probably on a 6% dividend yield should find some level of support down here. Newcrest, so we've seen the Swiss referendum will vote on increasing their gold reserves that failed or was a no vote, and I guess that largely met market expectations. But what we are starting to see is increased demand for gold out of China and India, just in the recent data over the past few months. Newcrest continues to do everything they can to mitigate costs, pay down debt, and it really is dependent on gold trading up to $1,400 an ounce to really see Newcrest do too much beyond sort of track sideways where it is at the moment. Origin Energy, so we've seen these oil and gas stocks obviously come off substantially. To put some numbers on this from an earnings standpoint, if we back out any chance of earnings growth in FY 15 and recognise in FY 16 Origin will have the benefit of additional LNG income from their Curtis Island project, and we just assume that over the next 12 months there's no growth in Origin, what does it mean from a valuation standpoint? If the company can deliver around 65 cents of earnings per share, still pay out around 50 cents of dividends, the stock trades on about a 4.5% dividend yield down here at these levels. So I think if you form a view that oil and gas prices largely consolidate from where they sit at the moment, I think the new range for Origin is maybe 11.50 up to sort of 12.50. So any rally from here back up towards this 12.75 level, I think it's an opportunity to sell the covered calls at around $13 and drive that extra cash flow from the dividend and the call premium. Orica not doing there at present. Oil Search. So again, with these oil and gas names, our preference has been to try to shift capital across to Woodside Petroleum as much as possible, but probably the order of preference being Woodside Petroleum, Origin, Oil Search, then Santos. Oil Search has the benefit of the revenue streams coming through from their Papua New Guinea LNG project, but with prices sort of where they're at the moment, it really does cloud sort of what that forward dividend distributions likely to be. The market was looking for around 20 odd cents in 2015, and I think that just now comes into question. So we'll wait a little while to see where support establishes there in Oil Search. QBE not doing anything there at present. Ramsay Health Care, obviously a strong trend there in place with Ramsay, but the stock's trading on a very expensive PE up at around 28 times earnings, and again on a dividend yield of around 2%. Rio, the company seems pretty adamant that they're going to be able to return capital to shareholders next year, whether it be in the form of a share buyback or a special dividend. So even with iron ore prices where they are, but the big ramp up in production, we're looking for about $2.30 of dividends out of Rio in 2015. Stock trades about 10 times earnings on a 4 and a bit % dividend yield. And I just sort of bring the commentary back to the start of the recording, where if we do see the market, global GDP pick up off the back of these ECB and BOJ stimulus measures that are being provided to the global economy, I think the net a beneficiary of these will be these commodity prices. The probability of iron ore and oil staying down at these levels, I think, is probably at the lower end of the spectrum. I think we're probably likely to see up to 10% improvement in the near term out of those. So that net should be positive for Rio. Again, I highlight from a technical perspective, there is a negative structure in place which would suggest that the pressure is to the downside there in Rio, but needs to be balanced against that sort of longer term view on the economic outlook. Stocklands, so this pays its dividend on the 23rd of December, roughly around 12 cents. We own the stock at lower level. Again, from the dividend and the call option, we're bringing in around 10% cash flow. So after owning it at lower levels, selling the covered calls at around the $4.10 level, we're effectively delivering the stock at around $4.20 again, if the stock was to fall back below that 410 level, a combination of the dividend and the call option driving over 10% cash flow. Sonic delivers, Stocklands should deliver about 6 to 8% earnings growth. Sonic Healthcare, so we're just starting to add this back into portfolios. We did own it at lower levels. We'd taken profit up at around $18.50. The company's gone from guidance of around 5% earnings growth to guidance around 2%, and that was responsible for this readjustment in the price. But I think there's enough supportive factors on a 1 to 3 year outlook to justify buying into Sonic, and at around 16 times earnings and a 4% dividend yield, I think it's worth owning again now and selling the covered calls up at around $18.50, and again driving that cash flow up to around 10%. Santos, as I highlighted, I think oil's probably due for some type of bounce. Once that correction starts, we'll revisit whether Santos is our preferred oil and gas name to have exposure to, or whether we look to transition that across to the stronger balance sheets of Woodside Petroleum and Origin. Suncorp, continue to like this name, so the probability of the company returning capital to shareholders over the next 12 months, the stock trades on a 6.5% dividend yield and about 13 times earnings, so there's certainly some relative value there emerging there in Suncorp. So we're just starting to reallocate capital here. As the stock pushes up to around $15, we look to sell the covered calls. Sydney Airport's coming into a distribution at the end of December, but for our money, the preference is still Transurban over Sydney. And Transurban, to put some numbers on this, about 40 cents of dividends likely to be paid out over the next 12 months. The stock trades about a 4.5% dividend yield, and with bond yields moving lower, so we're starting to see the market price in the prospect of the RBA cutting interest rates here in Australia. So that's seeing capital flow into these defensive yield names, and Transurban's certainly been a beneficiary of those capital flows over the last few weeks. But I think at 4% yield, 4.5% yield, it's starting to get to the top end of the range. We'll see the dividend distribution around 20% come out at the end of December, and I'd expect to see the stock sort of pull back a little bit and maybe underperform marginally after that dividend. Telstra, trading about 5.5% dividend yield now, looking for about 34 cents of distribution over the next 12 months. We own it at lower levels. Again, like sort of some of these other names, Amcor, Brambles, Telstra is one that we want to keep exposure to. So to the extent that we'll be delivering it under the covered call, we'll look to buy back into the stock and resell covered calls at a slightly higher level to ensure we keep exposure to the February dividend and again that extra call income into the early part of New Year. Toll being a beneficiary of the lower oil prices, so the transport stocks in Qantas and Toll we've seen some reasonable rallies out of. I think Toll though has some earnings growth issues, putting aside the added benefit from lower oil prices, but the stock probably only deliver 0 to 5% earnings growth. Maybe it's at the top end of that range now with the lower oil price, but on about a 5% dividend yield, 14 times earnings, I don't think there's too much more upside left here. So we've taken the opportunity to sell the covered calls into May. We've got 25 cents for those, which gives an effective exit price of around $6. If we get called for the stock ahead of the February dividend, that'll be fine. If on the other hand we don't, again we're turning that sort of dividend yield of 5% into about 10% per annum from a combination of that call and dividend income. Westpac Bank, 3% underlying earnings growth, good structural uptrend. I think this is sort of our preferred banking exposure. Maybe trades from here up to around $34, $35. Don't see it too much beyond that. Wesfarmers, I should say, stock's trading back now at about 19 times earnings on a 5.5% dividend yield. I think it's fair value. There's a place for it in portfolios, but only under a sort of a buy right scenario. Again, Westfield, this US dollar earners, we're likely to see some further earnings upgrades come through here, but put some numbers on this. In the absence of those earning upgrades being confirmed, the stock trades almost 20 times earnings on just over a 3% dividend yield, so getting pretty expensive. But probably like some of these other US dollar earner names, there's probably not a huge amount of downside. Maybe we get a period of prolonged consolidation, but really not too much volatility on the downside. Woolworths, I think, starts to represent value here. We've seen the company, so interesting the reaction here, and we're all probably aware of the issues, the potential issues with Master Hardware's competitors coming in, but really I think, you know, the company's guided towards 4% earnings growth. Their range had always been 4 to 7%, so they've now identified that FY15 earnings will be at the lower end of that range, around 4%. That still puts the stock on a 4.5%, almost 5% dividend yield, and back at 14 times earnings. Now, it's been a long time since we've seen Woolworths at 14 times and a 5% dividend yield. So I think it's a buy on the dip here. It rallies back up to maybe equivalent of a low 4% dividend yield, so up to around $32, $33. We'll do that as it comes into the February dividend or March dividend. And I think that's an opportunity to try to sell the covered calls. But for capital that's available in portfolios, we're certainly looking to reallocate that into Woolworths at or near these levels. Woodside Petroleum, I think the best balance sheet within the oil and gas space. The stock trades, all things being equal, at about a 6% dividend yield at present. The company pays out about 80% of its earnings. It's on 11%. 11 times PE, so we're looking for about $2.30 of dividends over the next 12 months, and I think the story's the same, where we probably see some type of recovery of up to maybe 5 to 10% in oil prices. That's an opportunity to sell the covered calls and drive the extra income out of Woodside. And there we are back to the index, which is the top 50 stocks. Now, interesting when you look at the returns for the top 50 market, it really on an annualized basis, it's only been around about 3% return. So any performance in portfolios that exceeds that benchmark of around 3 to 4%. Effectively, you're outperforming the index, and on the whole, Investor Signal's portfolios have certainly achieved that. I still maintain that a bulk of the assets in the top 50, this strategy of buying the stock, selling the covered call, collecting the dividend, is the lowest risk way to manage a portfolio. It reduces volatility, so in a down market it provides you some level of protection in the context of the income coming from the options. You still manage to keep exposure to the uptrending stocks such as your Brambles, your Westfield, your Telstra. Yes, you have to cycle through them through delivering them and buying back in, but then the other part of the portfolio that does move sideways, and we've looked at a number of stocks where that's the case, you're getting that added benefit of the call option to complement the dividend. And again, so the net effect of all this is that in a down market, the portfolio should have lower volatility. In a sideways market, you should outperform the index through the added income from the call options and effectively delivering stocks at higher PE valuations and buying back in at lower valuations. And in an uptrending market or a strong uptrending stocks, you're still managing to keep exposure to the bulk of that uptrend. So I've maintained that sort of a strategy of sticking with the companies that have growing earnings, a strong balance sheet, and running the covered call strategy is the optimum way to manage a portfolio, especially for superannuation funds where they're in the distribution phase and are looking for sort of those commonalities there of low volatility and high cash flow out of portfolios. And if you'd like to chat with me more about how Investor Signals can work in partnership with you to manage your portfolio, please contact me using the details on screen.